if we go into a recession, even gold sells off. And that surprises a lot of gold investors out there. I've shocked them all the time with that one. If we go into recession, you will sell your gold position. You have to cover your losses elsewhere, and no one's actually worried about inflation during a recession event, so that's the worst case scenario.
Now, you've just been doing some rounds with investors, chatting and catching up with them after their holidays. What is their current thoughts on the world?
A lot of concern among the English about the upcoming Ashes series, which is great. So we're on the right track there. Outright depression because they are back from holidays. So that's just today and yesterday. So a lot of people that are pretty down at the moment. And in my world, they're sort of focused on still Trump tariffs and the fact that the world's splitting apart, and so they're sort of expressing that subdued outlook in our equities, which is a bit tough.
Yeah. So. And is that split predominantly, the meeting that was going on yesterday and over the weekend?
Well, yeah, I mean, there's Trump-led confusion. So he sort of catches up with his mate Putin in Alaska. And then Putin catches up with his mates in India and China. So they're doing that this week. So I think the individual investor out there is very confused about where global growth's going. Deglobalisation's set in place, global trade's in trouble. So they're all thinking about those sorts of macro themes rather than good old-fashioned supply-demand fundamentals, which I think about. So it's pretty weird. And
which one's winning at the moment?
Without a doubt, gold, and if you can't afford gold, buy a bit of silver because they're both heading in the same direction. So gold sort of touched on record highs yesterday, I think 3,500 an ounce.
Let's get the chart up for you.
We need some charts. And so lots of incoming. So some people investors in Australia, South Africa, and all the gold mining provinces are sending emails saying, "Hey, record high, Tom, and you're a bear. How's that going?" So sort of trying to put up with that. But yeah, it's not just about rate cut expectations. I think people are buying gold because they're worried about the security of the US Fed. So it's under attack from President Trump. He's sort of undermining its independence, and so people are buying gold on the basis that the financial systems are under pressure.
Yeah.
So it's more than just a rate cut, and then all the other classic themes like ongoing deglobalisation, currency debasement, trade uncertainty, and so on. They're all factored into the thesis of buying gold. So.
But the bear case would be more predominantly on the demand supply metrics without that demand.
Yeah, it really upsets some investors when you talk about S&D and gold world because it doesn't really matter. But there is a concept of demand. People buy gold, put it in a back room for expectations the world might fall apart, and so on that basis, there's a real demand driver in play. So.
But it's got the momentum behind it just now, doesn't it?
It's a full-on momentum trade. Again, when you get incoming abuse and you've got the opposite call in place, momentum's underway, and they're piling into the trade and have fun with it, But they are risky trades. If there is an end to one of the conflicts in the world, so Russia and Ukraine suddenly do a deal, then that would take a big chunk out of the gold price. If China and the US sort of come up with sustainable agreements around trade and tariffs get scaled back, that's bad for gold. So these things can turn the gold story into a bear story very quickly.
Do we have a better sort of prospect for silver?
Well, they roughly track each other, but in this environment where global growth's under pressure, the other important driver for silver is industrial demand growth, and that's under pressure. So silver should actually underperform gold in a weak growth deglobalisation sort of scenario.
Yeah.
And if it reverses, like war resolutions and tariff rollbacks and so on, then it should flip. Silver should outperform gold. So you should always keep in mind the industrial driver for silver. That's an important differentiator. But generally, the prices track each other.
And so that's predominantly global growth and industrialisation.
Yeah, and silver feeds into photovoltaics, mainly, and other industrial applications. It takes up about 50 to 60% of demand for silver, something gold just doesn't have. It's a financial play.
Right. Which one would you feel more comfortable in if you had to choose between the two?
Look, I am a bear on gold. We talked about this last time, but right now in this environment, I'd be quite happy to hold gold, and so my preference is gold over silver.
Okay, great. Shall we move on to iron ore?
Yep. You know, my job is to write stuff about that chart. It's pretty hard. Sometimes I make things up. but we're coming into a tricky time of the year for iron ore, and this is a problem for Rio Tinto, BHP, FMG if you're in Australia, VALE, the monster out of Brazil. Come September, the steel trades across Asia particularly start to wind back their steel production rates. They destock all their raw materials. They don't take phone calls from Australia or Brazil, and take assets offline, and we go into a decline. And that typically reports all the way through to that flagship signal for the iron ore trade. So my expectation is some downside into Q4. So I wouldn't touch iron ore exposure until later on in the year, and I think I may have said that last time, but I'm sticking with that case.
You did indeed, and then that leads us into Rio's as well, because remind us the split of Rio's revenue stream. Yeah,
so about 60% of EBITDA's iron ore based, and I think about 20% is copper. So it's mostly iron ore, bit of copper.
Okay.
And it's very similar profile for BHP. But investors, if they're in this stock, in these diversified stocks, they're also trading the macro. That's just a reality. I mean, here I am talking about commodity exposure, but if there's not a great deal happening in the commodity price action, the residual driver is macro, and as we've kicked off this chat today, it's not great at the moment. So investors in resources regard this space generally as a risk trade, and so they'll be withdrawing from it and putting it into a safer position if they can do that. Resource-only investors can't do that. They're sort of stuck in this world, and they'll probably go to the cash cows with top quality assets, and so Rio and BHP benefit from that trade, but the generalist exit is a problem for them.
And then, what about? Are you getting incoming questions about the dollar, and if we see a significant and prolonged sell-off in the dollar?
Yeah, that's a good question. So right now, commodity prices, and we're talking about gold and silver, but they're actually all lifting. So oil, copper, aluminium, weird stuff like nickel and tin. So there's a general lift, and that's just a mechanical response. So that's the initial mechanical response to US dollar weakness on tariff themes, global growth themes, and so on. Yeah. So. And of course, the strong expectation after all of the US data comes out this week that the US Fed will probably do a cut anyway on the 17th of September. So markets are positioning for that theme, and what that does is it reduces US rates, reduces the US dollar, and reduces the opportunity cost of holding no yield assets like commodities, and they go for a bit of a run. Yeah. But the backdrop that's caused that is still inherently bearish, and so you get the initial kick and then the fade. And so I always try to tell investors, just beware of this sort of dynamic. Yeah. You've got a short-term trade on hand, and when I say short-term, it's like a week or two. Right. So be careful, and see if you can back out of it after that. So if you're doing short-term trading, go liquid.
Portfolio managers have rules, I guess, in their mind, and it's right. Okay, the inflation trade, well, that is mining. In commodities, but there are certain inflation trades that are stagflation, and that's it's the opposite. There's some commodities you don't want to be in at all. Yeah, so if you can trade all commodities short term on the inflation risk theme. So copper and gold, for example, in the last 3 years, they pretty much tracked each other, even though copper's essentially an industrial metals and gold is a financial play. Yeah. But when you've got an inflation spike, again, they'll all lift initially, and then the industrials will fade. So copper will fade, and theoretically gold and probably silver will hold up reasonably well. And then eventually silver will fade and track copper if the world goes pear-shaped. And if we go into a recession, even gold sells off. And that surprises a lot of gold investors out there. I've shocked them
all the time with that one. If we go into recession, you will sell your gold position. You have to cover your losses elsewhere, and no one's actually worried about inflation during a recession event. So that's the worst case scenario.
Yeah, and it's certainly not as much, but there's day 7 when you're putting out fires everywhere.
Yeah.
That you're sitting with that nice shiny thing that is right.
That's. I think I've seen you do that too, actually, Richard, on a trading desk. So,
Guilty.
Yeah, freaking out as the day set in. So
Yeah.
That's. Yeah, it's the last thing you're left with, and you're very reluctant to let it go, but sometimes you have to.
Yeah. Right. Well, you mentioned copper there, so let's. Well, first of all, let's have a look at the whole space there. The guys are going to get that up for me. There it is. So the HGA 456. Now that, when you were on last time, was $5.40. So.
Yeah, I mean, thanks for saying I got the call right, but there's no way I was expecting Trump to backflip on the day. But that I was talking about the fact that it was completely unreasonable to expect that Trump would push ahead with a 50% tariff on the most critical commodity input for the US economy. Yeah. Copper feeds into the whole power gen system and consumer goods and so on. But you know, he's Trump. You don't know what he's going to do. But I was amazed that he backflipped completely out of it. And you know, in any other time, people would be investigated for a turnaround like that. But it happened, and as a commodity analyst, I was fascinated by it because I've never seen price signals of a commodity trade so thoroughly tortured like they were in the months leading up to that, and how it's just gone back to where it was pre-April time. It's incredible.
And did you expect, because it traded basically $4.40 for about a week.
Yeah.
Did you expect it to go that low?
So talking to copper trading mates, they basically said, well, the only benchmark we had was, you know, the price level before he talked about tariffs. So you have to go back to, well, certainly before April, but probably February. And they used the February time level as the benchmark. And they've just gone, all bets are off, we're just going back to that level. That's the sensible benchmark we can work with. Okay. And they seem to be building positions from around that level now. So. And now it's, I think, at 460 for US copper. So, so it's now responding to rate change prospects this week. So we'll see how that plays out. But my expectation is a lot of flurry around the US data, macro data being reported this week. So we've got trade, labour data, the beige book, isms today. So the market's positioning to hopefully see, for them anyway, expecting data to come through to confirm the thesis to cut rates. So that's what they're playing at the moment. If there's any disappointment, you'll probably see a bit of a sell-off. So this is a choppy week for commodities, particularly for copper.
Yeah.
So.
And how's that feeding into Glencore? Where do we sit with Glencore?
Well, poor old Glencore, you know, I feel sorry for those blokes. Lovely guys.
Tough,
and they've just been kicked around all year. So in troubled times, as I was saying before, if your mandate is resources and things look dodgy and troubled, you'll rotate your money into high quality stocks. So Rio and BHP are your giant cash cows. Yeah. And Glencore and probably Anglo would come under pressure. That's what history shows over the last 5 to 10 years of trading. Yeah. And so they're struggling on that basis. Glencore's taking an extra hit because coal prices have come under a lot of pressure. Okay. But things are stabilising for Glencore because we've actually seen a recovery, a stability and recovery across thermal and met coal, and they are the biggest exporter of coal products in the world. So that'll put a floor under their equity performance. But still, the macro drag is a big problem for Glencore. That's what they're battling with. So I'd be cautious about jumping back into that stock, even though it's the underperformer and out of the diversified group year to date.
Who gets the, and guys, can we just pop the chart of Glencore up there, please? Who gets the biggest kicker if we get a prolonged talk of stepping away from net zero, as Kemi Badenoch has started to argue?
To like a recovery story. So it's the exact opposite of what I said. If things improve and the market stabilises on a shift in macro, I would expect a rotation out of quality stocks back into Glencore and Anglo. So Glencore and Anglo will pop out of the diversified group.
More on the coal side of things, for example, if the environmental targets
net zero,
are
okay,
lessened.
Okay, so Trump leads the charge and says coal's great, make coal great again. Then Glencore's an obvious beneficiary.
Right.
And Anglo, ignore the Anglo call because it's spun off its thermal coal into Tungala and it's trying to get rid of its met coal assets.
Okay.
Everybody doesn't want them. And other beneficiaries would be all the coal pure players. So think about Aussie pure plays like Whitehaven, New Hope, Shenhua, China Coal in China, and Bumi in Indonesia, and Peabody as well. So all of those guys would have a bit of a flurry as the power systems around the world feel a bit more comfortable about engaging coal-fired power gen systems. So,
do you look at uranium at all?
A little bit, yeah. So
what do you think of that?
Yeah, so it's had a little bit of a bounce. It was stabilised around 70, and that's about the marginal cost of production for the industry. Then it rallied to 75. Please have that up on the screen. Yes. So a lot of excitement, mainly from North American investors. We talked to a lot of those guys. The driver there this week is Cameco. So they're the second biggest producer after Kazatomprom, I think now.
Had an amazing run, didn't it?
Yeah. So quality company, sort of almost vertically integrated because they do uranium mining conversion and they've got interests in power gen systems, nukes, in North America. They suddenly announced a closure of production troubles at their flagship operation, the McArthur River facility. So global market's about 180 million pounds. The mined portion is about 140, and Cameco on a good day does about 20 million, 25, could do 30 million pounds a year. So it's a big producer, and almost all of it comes from two operations that they control, McArthur River and the Cigar Lake operations. They're claiming that McArthur River is struggling, and so instead of getting to about 18 to 20 million pounds, apparently they're only going to get to about 14, 15 million.
Wow.
The market's so excited about that, but in actual fact, it's probably only a couple of % of global supply. So it's probably not as big as people think. And I wrote a comment yesterday about it, got a lot of incoming grief from Canadians.
You don't want that.
You don't understand it and all that stuff.
Did they still say please?
Yeah, they did say please, and they're back from shooting season in Canada, so they're extra aggressive. But yeah, I'd just be cautious on this one. The price downside risk is limited at 70, but I need something more substantial to come through for a sustained lift from the marginal cost of production, and maybe an expanded conversion, enrichment and reactor build out in the US, because they've actually funded that. If we get some more numbers on that, I'd get more interest in uranium. But there's no rush or need to rush anywhere at the moment, just hold fast.
Now, take me through Indonesia. I believe there's a few problems down there.
Yeah, it's not a happy place, so lots of protesters. That's a big deal for me because they're a big producer of thermal coal, obviously. So 40% of the world's thermal coal that's traded, over 500 million tonnes and a global market of 1,100, comes from that country. And they also do copper, gold, tin. And so obviously a lot of government revenues come from the royalties and trade flows of that material, and so it's not good that the government may be having a bit of pressure with the local community. So why are people protesting? Apparently they're upset with very generous benefits that have been handed to parliamentarians there, and they're really angry. But it's a bit confusing because the Subianto government is actually very pro the community. They're actually rolling out some very expensive programs. One's basically free food for school kids, and that will be a very expensive program, and the mining industry is supposed to fund it.
Right.
So it's odd that everyone must be happy about that, but then these benefits to parliamentarians are being targeted, so these things don't add up, and I think there's obviously some sort of political game being played here.
Right.
But so far, no impact to mining, but it's a risk worth tracking. If the government has trouble sort of managing those sorts of themes in government, we could see disruptions that report into the mining sector, and that will starve the market of very important supply flows. So that's probably one worth tracking, particularly for coal.
Right, definitely. Now, oil is the one we haven't touched on yet.
We've gone through everything, haven't we?
Yeah,
oil,
much,
so prices, a lot of people are frustrated by the Saudi policy of delivering surpluses to this trade. So it's an almost 100 million barrel a year trade. Saudi's obviously a major player in that. Right now they have the official view is the Saudis are delivering a surplus to the market to cap the price. And we're being told that they're frustrated with some of the marginal players in OPEC. Kazakhstan's one of them, and they're sort of punishing them for producing in excess. If the Saudis produce a surplus in the market and bring the price down, Kazakhstan will have no choice but to reduce their production because some of that will be loss-making. And so that theme is going around the market as the main reason for it. But I think there's a political angle here. The US basically gave the Saudis a $140 billion weapons package in May, and that policy started immediately after that. So I think the Saudis have been funded to deliver this surplus, and it just makes the US government look really good with the low oil price. So it's probably worth looking at other events in the market outside of what we're actually being told in the news flow. As a commodity analyst, I'm intrigued by that because it reduces the cost of production and delivery of all other commodities. So it reduces the cost base,
of course,
and makes it cheaper to get it to consumers. So and it doesn't look like the price is going to budge from the 60 range.
And yeah, I was going to say, what do you think the floor is?
Well, the Saudis are in pain below $60 a barrel, so I'd say think about 60 to 65. That's probably what they're happy with to hold for a short period of time. Yeah. And I'm talking the rest of this year sort of thing.